We will always recommend fixed income as part of a well-diversified portfolio, but at this time, finding value in the fixed income market is extremely challenging. The Federal Reserve has driven interest rates to near record lows, and as you can see in this chart, what happens when interest rates go lower, your interest rate risk in owning the bonds gets higher. So what you're basically doing is clipping your coupon at best. So we try and find opportunity to give you extra yield in the portfolios, and where we would do that would be in the credit market. But we think it's irresponsible at this time to be reaching for yield and sacrificing your credit quality for that yield. So we would avoid the high yield area. We would be underweight high yield. Our concern with high yield right now is that spreads, or that extra yield that you earn to take on that credit risk, has really narrowed. We're almost at pre-pandemic levels. Now, while investment grade gives you a little bit of extra yield as well, it gives you better credit quality. So we would feel more comfortable at this stage with investment grade over high yield. We do also like emerging market bonds. Emerging market bonds are giving you an extra yield as well, but you're dealing with government debt now of economies that are improving, are not expected to contract at the same pace that the developed markets did, and most importantly, we've seen lower inflation and inflation coming lower in emerging markets, and that can be detrimental to bond returns. So we would rather invest in the emerging market bond area. From a maturity perspective, short to intermediate term bonds, that will help mitigate some of your interest rate risk as well.